Hey everyone, hopefully you're having a good day. My name's Andy, my channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it together, generally related to three different topics: wealth building, commodities, and or financial topics. Let's dive right in, see what's going on today. If you want to follow me at @Finance, and if you want to join our community, finding-value.com, where I dive deep into all these topics, looking for investment opportunities and sharing those opportunities with everybody in the community. I do that through midweek updates where I share individual stock and sector opinions. And on the weekend, I answer your guys' questions through Q&A sessions. And I also usually share what I think is important information on how to become a better investor. If that sounds interesting, Special is a coupon code that can get you savings on both the monthly and yearly memberships that you can see in the description link below. We've got Russian petroleum product exports at their lowest level in years. Wait, I thought we had this huge oil glut. Why are exports going down? I'm just going to say stuff, guys. Oil, if the price is too low, and I don't know if it is for Russian oil exports, but if the price is too low, the natural decline rates across the world will eat into production. And all you have to do is wait. Wait as in wait in time. It will come. Exports are going to dry up and the oil price will move on up. We are in a very cheap location for oil. I will dig into that here in the next few minutes and show you how cheap it is. So Russian exports, yep, they're declining about 2 million or 2.5 million barrels to below 2 million. That's what, 600, 700,000 barrels of oil decline since April of 2025. It says oil stocks are where gold stocks were 2 years ago. Oil stocks were where gold stocks 2 years ago. A lot of people throwing out a lot of opinions. Well, let's see if we can validate that opinion. This is the crude oil to gold chart. This is a ratio chart. I like my ratios. I like looking for structure in charts. Structures like a consolidation of a three-hump consolidation breakout into a bull market. Then we had a nasty bear market of this falling wedge where the ultimate bottom was 2020. I put SS, which is a slingshot, slingshotted out of the pattern. And then usually when you break out of a pattern, you get a return move. We are doing the return move basically almost into a double bottom perhaps, or an inverted shoulder head shoulder formation. The formation isn't that important. It's about knowing that you broke the structure and that you are creating another falling structure, falling wedge structure, which is a bullish formation to break higher. And are we going to get the slingshot too, which I think we're kind of going through right now. So is oil like gold 2 years ago? I would say absolutely not. Absolutely not. I would say that last bull market is nothing like how we are positioned in today's bull market. Let me describe why I think so. So last bull market, we started with cheap oil in that circle there to the circle up top in 2008. That was the ratio of crude oil to gold. We were expensive against gold when we ended that bull market. Very expensive. Now, today, we are so cheap. We are cheaper than anything before the entire bull market before that. So the 2000 to 2008, today, right now, we blow the water out of the beginning of that bull market in 1999. We blow it out of the water and how cheap we are. In fact, on a percentage basis, let's get percentage basis here. If you take roughly where that is, we are 61% cheaper than the beginning of the original, or not original, but the beginning of the 1999 bull market, 98-99 bull market in oil in the commodity bull market. We are squeezed up here. And I've heard other people say that we are 7 standard deviations away from the average, if the average is in the middle here at 0.08. 7. And that looks to be right. So, no, it's not like gold 2 years ago. This isn't even like oil in 1999. This isn't like oil in the 1960s and 70s. Guys, I don't think people realize what this really is. This is an anomaly. We've never seen this. Oil this cheap against gold has never happened. Yes, it briefly touched it in 2020, but we're there again. Now, when I price crude oil against the S&P 500, I have to go even longer than this. 1 second to get all the data. Now I'm gonna go back and put this in white so it's easier to see. Guys, this is a ridiculous setup. What this is, I don't know how to describe this with the ability to understand the gravity of this. All right, the bull market it'd be in 1917. That bull market may have been as powerful as what I think we're going to see in crude oil. It might have. Everything else was in a consolidation from 1920, 1921. This is all a big consolidation. So crude oil 2 years ago, gold 2 years ago. No, this is not like that. This is a whole new era that we are embarking on that people do not understand. They won't be able to mentally grasp what I am saying because they've only lived in this era. This era looks different. It will feel different. It's going to destroy currencies different, if you know what I mean. I think that the root cause of our problems are in oil. The root cause. And that's what this chart is suggesting of what's coming. A major bull market in oil. Now, a lot of people are going to say high prices cure high prices. You know, it's great to hide behind what do they call that? Cliches. You know, a lot of people say high prices cure high prices. What if the foundation of modern society, which is built on oil, what if your problem is oil and you don't have any viable alternatives? You know, the Romans and some of these other civilizations, they built their economies around energy, which is that's what allows you to become a civilization or a society is you basically have an abundance of energy. I think they built it around wood, and then they had a wood scarcity, and it destroyed that civilization. Now, I don't know if that's what's coming ahead of us. I don't know. But this chart, the way that we're squeezing up, could suggest that oil is going to be a problem, and it could be a twofold problem. Let me describe it. If, and this is a big if, because I don't know for sure, but if oil is a problem, that means a whole bunch of things need to change in our life. Our currencies need to change. The way that businesses are priced today need to change. Our entire system needs to change. This long distance shipping all this crap around the world is going to have to change. We're going to have locally sourced everything. I think things are going to be very vastly different. Vastly different. But oil and energy is what backs a currency, and our currency is going to eat it. I mean, it's going to eat it if we have a problem in energy. We could go to war. There's all sorts of things. But we'll see. We'll see how this plays out. I think we could break out to the upside here. And it's going to be a little bit different world. Now, this is a very big long-term chart. This isn't going to happen tomorrow. It's not going to happen next week. It's going to take some time for this to play out. And there could be, we're probably going to try to solve it with alternative means. And I don't know if those alternative means are going to be successful. Pardon my engineering background. I don't know if we can wind turbine our way out of this or solar panel our way out of it. The energy is immense. I was reading, this was a while back, something about a gigawatt of power, and we need to be putting solar panels on 250,000 rooftops I think it was per day for 40 years to get 1 gigawatt. I think that's what it was, if I can remember right. It was something like 13 or 1400 wind turbines installed a week for many, many, many years to hit 1 gigawatt. But yet we want to put onto the system many gigawatts and then replace many gigawatts. It's like we don't have the materials to do it. So it's going to be interesting if things start to get a little bit more scarce, where maybe shale oil starts to peak out a little bit. But that's what this chart is suggesting. That's where I'm coming to that conclusion, is from this squeeze up of how we could potentially break out of this. So I don't think it's like that. I think oil stocks are where gold stocks were in 2000. 2000. So this is to show you guys kind of what this is. So let's do U.S. oil divided by M2SL. If you can see where we're located, we're in this like really low area. This is a false breakdown here. So we break out. We had a consolidation. I think we're going to get a big move here. So this is U.S. oil versus M2 money supply. See how cheap we are? This would be analogous to how cheap if we were to do XAU USD divided by M2 money supply. It's like being back here or even here, back maybe 2 years ago against the M2 money supply, maybe. But I mean, we are so cheap for oil. It is ridiculous. Been saying for a few months that the secular bull for junior commodities companies is about to resume. And now with the breakout below, it is about to. Been posting the chart below. Yeah. Okay, get it. Got it. You posted a while ago, the chart's breaking out. So it is breaking out. We've got this downtrend, broke out, retest, and here we are slingshotting higher. This is the Canadian TSX Venture log scale 3-year chart we're breaking out. What does this mean? Why does it matter? It means that the opportunities and the paradigm is shifting. Every single chart is a piece of evidence to a puzzle. What you have to do is you have to add these pieces of information up to see what the puzzle is suggesting. So if this is breaking out, what this is suggesting is that the TSX is going to outperform. Money's starting to flow into it. We're probably going to see Canadian dollar outperform the US dollar. And money is flowing differently. Also suggests that whatever the TSX Venture holds, like gold and silver mining companies, and maybe there's some oil companies, whatever's in there, is going to start to outperform. And money's going to flow into it. Morgan Housel, a letter to his kids. Let's see what it is. So it says, the art of spending money. Here's how I put in a letter to my kids. This may sound harsh, but I hope you're poor at some point. Not struggling and not unhappy, of course. But there's no way to learn the value of money without feeling the power of its scarcity. Your parents will work hard to support you and open the doors of opportunity. But you're not going to spoil you. We're not going to be mean. Learning that you can't have everything you want is the only way to understand the difference between a need and a desire. It will teach you how to budget, how to save, and how to value what you already have. Learning to be frugal without it hurting is an essential life skill that will come in handy during life's inevitable ups and downs. You know, I am really, really, I don't know if it's called frugal, but I just don't like spending money. And I always look at money as a way of a protection against the outside world. So it's a way to protect me against bad outcomes. It's cushioning me. That money is a big cushion between me and bad outcomes. And then when I go and I evaluate, what can I buy with it? What kind of experiences can I experience with the money that I spend? Or what kind of materialistic items can I buy that will actually make my life better? And then I come to the conclusion that a lot of money spent doesn't make my life any better. I already have what I would say is what's needed and what is wanted for a successful foundation to being happy. So I hear a lot of people, what are you going to do with the money? And then everybody wants to buy a Lamborghini. I hate to tell you guys, a Lamborghini isn't what's going to be that great. It's just a car. Now, I love cars. I absolutely love cars. Do you know a car that I would probably be pretty cool to experience? One that gives you some sort of like raw driving experience. Maybe like a K20 Honda engine in a Toyota MRS, a super lightweight car, get a little bit of downforce on it, and drive the living crap out of that thing. But that's no Lamborghini, and you can attain that for probably less than $20,000 easily. It's not about spending money to show other people what you have. That's such a skin only, a skin surface experience. And I actually feel bad if I were to try to do that. I would feel like a complete douche because it's not an extension of who I am. Me ripping around in a little, Spider or maybe a K24 swapped S2000 would be kind of cool. Get your torque up and stuff. Or maybe a 2GR FE Toyota, and a second gen Toyota MR2. That'd be kind of cool. Linear power delivery, rip that thing around. That would be so much fun. So I'd be paying money to have fun, not paying money to have status. And I would just feel so fraudulent that if I were to buy stuff just to show off, I would feel such a fraud. The oil supply glut is the biggest BS story out there. Soon markets will shift to the supply destruction story. It will. It will. And it will just take some time. Oil is cheap. That's where the opportunities are. If this is the scary thing. If we have a problem in shale oil in America where we can't grow it anymore and it starts to decline, that's kind of scary, guys. It's kind of scary, in my opinion. Dan says Patterson UTI is another big service company that sees current U.S. drilling completion activity that is not high enough to maintain U.S. oil production. And that's a drilling company there. They say in the U.S., oil production does not yet fully reflect the impact of activity reductions over the past 6 months. And we believe current industry activity is already below levels needed to hold U.S. production flat. Any further reductions from current levels would likely result in additional pressure on future U.S. output, which could negatively impact global oil supply in 2026. What happens is these guys drill, and then it takes time for these wells to kind of get moving. So it's a cycle. And if you continue to disrupt the cycle by reducing rig count and frac crews, which they have, we will see lower output at some point. But it takes a little bit of time for it to work through the system. Here's Latin America. It says LATAM, it looks set for the next move. Yesterday, we shared a high conviction commodity play in the region with our subscribers. It's a compelling growth story that also offers a dividend yield of over 10%, all while being one of the lowest cost producers in its sector. This is ILF Latin America that is breaking out. I also agree that there are great opportunities in emerging markets at this time. These breakouts are where you want to get in these corners here. And there's a lot of individual companies in Latin America that do look good, that are also commodity companies that I also like very much, which obviously we share on the website as well. Coming up, aluminum stocks, big moves today. Industrial catch-up trade in play for copper stocks, COPX. You can see the breakout. Steel stocks, which we are playing, uh, breaking to the upside. And aluminum stocks, which we are also playing. We purchased these down here, though. We purchased them down here, and then we purchased these down here. And then copper, we've been buying here too. So we purchased it before the breakout. Now, some people say, well, it's dangerous. It's dangerous to buy before a breakout. Guys, that's why I study the whole cycle. The whole purpose of seeing this cycle, the whole purpose of showing you these charts and buying them when they're down here, the whole purpose is to get as low as you can. It's not to wait for a breakout because you don't know the cycle. The cycle and the conviction in the cycle gives you the opportunity to buy early. But then you got to wait. You got to wait for all these things and everyone else to catch on. You got to wait for the technical analysis only people for chart breakouts so they can buy your stock at, 100, 200, 300, 400% higher than what you did. Investment wisdom. The beauty of it is that knowledge is cumulative. And even what you're learning about company A will help your thinking about company B, says Warren Buffett. Keep learning, guys. Keep learning these cycles. Oil demand hitting new highs, not only in America, but worldwide. So what we have here, it says, chart of the day, U.S. oil consumption is heading toward 18-year high of 20.59 million barrels a day in 2025, and further increases are likely. It's the underappreciated companion to the drill baby drill mantra that's transformed U.S. oil production. Demand is also booming. Kind of looks like to me that we've got a little resistance up here that we're ready to break out at some point. Maybe next summer we break out of this 20 million-ish demand level to new highs. Money printing, some people, they find it confusing. They're like, money printing is oil demand. All right, well, tell me something that isn't transported or produced by oil, or at least has some components made by oil. The lubricants, the transportation, the paints, that's all made through oil or fossil fuels. Or derivatives. I consider natural gas to be in the family of oil. So diesel, gasoline, lubricants, paints, everything in the healthcare industry seems to be fossil fuel based. All sorts of stuff. Our food is an extension of oil. It's just food is converted oil and fertilizers are from natural gas and oil. it's like everything. Rock Bottom says copper's chart looks exactly like gold before its 2024 breakout. $10 copper is coming. So there's the gold breakout. There's your cup and handle kind of pattern. And here is the similar pattern before the breakout of copper. So copper's about to hit it up next, break its 18-year trend line and do a big move. Oil is going to be slightly there behind it. And we're going to get these big, gigantic moves. You know where it all came from? Money printing. And now the money's flowing through the system. Copper's the next in line to get some of that. And oil will be too. Tim Hack says, I believe that silver has now successfully retested its 1980 high and will now become the victim of a parabolic rise to finish the initial formation with a potential of $100 by Christmas of this year. Is that going to happen? I don't know. Maybe. This is where I put my mindset. Okay, guys, I played a lot of sports growing up, and you got to enter this stuff with a certain mindset. I think what a lot of people do is they put these price targets in their mindset. And if it doesn't hit the price target by some date, they get discouraged. They get frustrated, or they don't like living through pullbacks. A pullback is like an injury when you work out. It's a little bit of a setback, but you keep driving forward. If you can identify the secular big bull market trend, which is like maybe that's your vision in a sport, like you're going to go work out and get stronger. Like that's your vision and your goal. The secular bull market is kind of like your vision and your goal. Like that's what keeps you bullish on the sector. In the short term, you get these pullbacks or injuries, and they consolidate for some period of time. And people, I think, focus too much on specific points, like $100 by Christmas. Now, if it doesn't happen, is someone going to say, "Well, Tim Hack said that it was going to be $100 by Christmas"? What I do is I look at the pattern, I look at the trend, and I say, you know what? We are trending in the right direction, and we're in a secular bull market. We've got a 45-year cup and handle. Everything looks good. And then I don't put price targets and I don't put timelines on it. I just remain open. And it's like, you know what? I want exposure to this. Let it go. And then if I start to see evidence that we've got some gigantic big move that we've broken out, and maybe we're at $200 silver, and we start getting a lot of selling pressure, then maybe I might think, you know what? Maybe it's time to take a little bit off the plate. We're getting a little bit expensive up here. And maybe the silver to gold ratio is down below 30 to 1. So 30 ounces silver, 1 ounce gold. But when you're early in a move, I don't put this price target and timelines. It puts too much pressure on the situation. Too many expectations. You want to under promise and over deliver. So I know people are bullish, and I don't know if silver is going to break out immediately. I don't know if it's going to take some time. Just enjoy the journey. Enjoy that you got a good low entry point, and I'm going to ride this thing. And whatever it's going to be, it's going to be. I'm going to see it through. So that's kind of my outlook on it. If we're breaking big patterns, I'm all about it, baby. But I'm not going to say it's going to be $100 by Christmas. That's just not how I roll. I just look at the pattern and say, yeah, this is a very good situation to be in and exposed to. I'm going to ride it. It's kind of like saying, let's say you want to get a job, right? So you're going to get a job. What do? Do you apply to one job, or should you apply to a whole bunch? And maybe you've got 10 different interviews. And some people would say, I don't want this. It doesn't sound good. Just go to the dang interview, spend a teeny bit of time, and learn about the position and the company. Maybe you like it. Maybe it's a better fit than something else that you had a preconceived notion about. So I kind of view the sectors like that. I look at all these sectors and I say, yep, these all have very big opportunities. And then I just go look. I go look at the companies. I go look around. I see how cheap they are. And I said, you know what? There's a lot of good opportunities in this sector. I would have never guessed that. One of the sectors that I kind of downplayed and that I wasn't that interested in was iron ore and steel. Now I look at it like, man, that needs to be in my portfolio. It's got to be in the portfolio. It's got so much leverage. So be careful about expectations. Be careful about setting these expectations like $100 by Christmas. Don't let it get you down if it doesn't transpire the way that people are talking about. He doesn't know the future. No one does. But I can tell you it's a good opportunity. And I step up to the plate when there's good opportunities. The crude oil price divided by the S&P 500 has worked its way down to December 1998 levels. At the time, everyone wanted Yahoo, Cisco, AOL, Oracle, and so on. Today, it's AI stocks. The S&P 500 energy sector went on to outperform the S&P 500 for the next 10 years. And look where we are today. We are in the same situation as this ratio of crude oil divided by S&P as we were back at those times. So this is the opportunity. It's like stepping up and doing an interview. And if someone says, you know what, people were making fun of me because I'm buying oil stocks or I like oil, I don't want to do it. It's like, screw that. Do the interview. Get up there. Take a chance. Look at stocks. Look at what's cheap. Get some exposure. Get enough where it makes a difference, but not too much where it can really hurt you. And ride the damn thing. It's the only way you can make money. is you got to be able to take up or take these opportunities and size them up appropriately at a time when it's really cheap. That's your opportunity. So if someone says, Andy, you didn't tell us, I'm telling you right now that oil is an opportunity. I'm coming out and telling you oil is an opportunity. Iron ore is an opportunity. Steel, copper, opportunities. This whole thing, there's all these opportunities. The way that you approach it and the mindset and the ability to hold on is all up to you. Now, I can help, obviously. I'm helping people on the website look and how to allocate and find companies of things that I think are very interesting and have a lot of leverage to the upside. And I'm doing that. And I think that's probably where we're going to end it because I think that's why I went over this last time. So that's where we'll end it today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you'd like. Specials coupon code. We have a Saturday question and answer session coming up, 7 a.m. You might be viewing this at 7 a.m. because that's when I usually release them. But that's when we have them, is 7 a.m. Mountain Time. All right, guys. We'll catch you later. See ya.